Welcome to the 2015 OFG Annual Report Luncheon. Please continue eating, get seconds, get some dessert, so that you have a better vantage point of the screen. There should be several seats that have opened up from the students coming over here, preparing for showtime. Just feel free to move where you can see. This is the 13th year of OFG. For some of you, this is your first luncheon. For some of you, like Sherry Schumann, this is your 13th annual report luncheon. You have perfect attendance at these. All of you are important to us. You have helped shape our program. We greatly value your friendship, your support, your encouragement. Thanks for taking time out of your busy schedule to be with us this afternoon. There are 10 OFG alums here today. That's the most ever. Alums from OFG editions 2007, 2008, 2009, 2010, 2011, 2012, and 2013 are here. Stefan Scheib interrupted his research on his finance PhD dissertation at FSU to drive from Tallahassee to be here today. Rob Urban emailed me a couple months ago about the date of this luncheon. I emailed him back, and 5 minutes later he emailed me back that he booked his flight from Charlotte to be here. And all of the local alums scheduled their days to be here. George, you are sitting with your students. The alums are concentrated on this table here and the table beside it over there. George, you helped train them in portfolio management. So these are your students. More about George later on in the presentation. Alums, thank you so much for being here, for encouraging your Osprey brothers and sisters. Looking out at you all, I'm so very proud of you, so proud of your success. You are excellent ambassadors for OFG, the Cogman College of Business, and UNF. Thank you so much for being here. I would now like to introduce our Dean, Paul Mason, who will give some words of welcome from the Business School.
Thanks, Ronnie. This is not like Shari, my 13th, but my first OFG luncheon. I would have liked to have been invited to other ones, but this is the first time. I wonder if it correlates with me being the acting dean. There's an ongoing debate in academia over what the best way is for people to learn. And there's discussions about in-classroom, about online, about synchronous, non-synchronous education. But the majority of the emphasis in education in general is on the two issues that seem to help students learn the best, which is people learn best by doing or by teaching others. And what's great about OFG, and I've seen this in my own classroom and dealing with the students from OFG, is the OFG program allows them to deal with real-world money in real-world facilities and learn by doing. And because you see the large group that works together in this regard, they're teaching each other. So they really take advantage of the best of both of the ways that we think people learn the best. Naturally, OFG wouldn't be possible without the support of the business community and the alumni who have come back to give their expertise and to provide their opportunities to our OFG graduates. And so we thank you very much. In addition, I want to point out that it's because of your involvement that we can be innovative in the classroom beyond OFG and develop new programs in finance. For example, we are presently offering classes in behavioral finance, which is externally supported. And we also have a course in fixed income, which is related to that process as well. Two innovative new techniques that have come out of the development of OFG. So to the business community in that regard, we thank you as well. We also want to alert you to what we intend to innovate further in the college in the future. One of the things that I've been pushing hard in my role as acting dean is diversified master's programs. Programs that specialize in transportation, that specialize in logistics and supply chain management, that specialize in finance and/or investments. Those are on the horizon. The faculty are already in the process of developing those programs, and we think in the next couple of years that those programs will be on the books for those of you in this room as well as for future students. The Cotton College of Business is not satisfied with the status quo. We are trying to push to be bigger and better and more productive for our students and for our community, and we appreciate your help in doing that. Thank you.
Thanks, Paul. The objective of OFG is to prepare students to transition from the classroom to the real world. Students have a training room and other resources that the professionals have to manage money. A few years ago, Oliver Schnusenberg designed a course that would prepare students to use the data from Bloomberg to build models. We've tried to coordinate OFG with financial modeling because we believe the skills that combination produces makes our students more marketable. Oliver is going to come up and tell you a little bit more about the modeling class because it plays such a big role in OFG.
Good afternoon, and thank you, Ronnie, for allowing me the opportunity to tell you just a little bit about financial modeling, which is designed to take students to the next level. Financial modeling is the process by which a firm constructs a financial representation of some or all aspects of a firm or a given security. The model is usually characterized by performing calculations and makes recommendations based on that information. And model, the students did. Using feedback from UNF alumni, we identified skills that would be valuable to our students in such a course and that are actually used by our alumni in the workforce. As for OFG, students had to interview to enroll in the course and become Bloomberg certified over the summer for a fall course. The setup of the course is designed to teach students not only Excel skills, but critical thinking and communication skills as well. In rotating teams of 2, students have to present to the class on 6 different modeling topics, including a self-selected topic, using data of their choosing. Students also have to critique another team's work. Topics in this course range from Excel-centered themes such as data tables, pivot tables, web queries, and macros, to finance-oriented topics such as pro forma financial statements, stock price simulation, and bond immunization. This fall, companies will become involved in the course, and students will work on a project that companies actually undertake or have undertaken. Companies such as CIT and Wells Fargo will meet with students to assign a project early in the semester. Students will then work on the project in groups and will present their recommendations to company representatives who will assign a grade for the project. We are constantly trying to improve our performance to provide you with students that can hit the ground running once they work for you. Non-OFG modeling graduates, notice that distinction, are placing at companies such as the Federal Reserve Bank of Atlanta, CIT, Merrill Lynch, and Capital Motors LLC, where one of the former graduates is an owner-president. One former student is now attending James Madison University. Thank you for your attention, and now back to the regularly scheduled program.
OFG is about the students. The fund is not faculty managed or LAM managed. It is truly student managed. And I believe, Earl, you would agree that this is what Jody and Leighton Smith envisioned when they gave the gift that launched OFG 13 years ago. So I'm going to turn it over to the students now for the remainder of the program. Colleen Kinnavan is going to lead off, and she is going to tell you a brief history of OFG.
Thank you, Dr. Lim. Give me 1 second. It's like it was queued up for the middle of the presentation. Okay. So before we get started describing our performance, we'd like to take a minute to thank several people. None of this would be possible without the support of many individuals, but we'd like to thank a few specifically. First of all, the UNF Foundation and Investment Committee. Thank you for giving us this opportunity and having confidence in us. Our Dean, Dr. Paul Mason, Dr. Jager, and the members of the finance faculty for their knowledge and support. George Prados and Morgan Stanley. Mr. Prados is a longtime friend of OFG and the professional community. He has invited every class of OFGers, we're the 13th, downtown to visit his office and talk business. Mark Travis and Intrepid Capital have provided long-time financial support, especially for travel. Dave Welling, OFG alum Kyle Fleming, and Black Diamond Performance Reporting have generously allowed us to use their statistical software, which has not only helped us manage the fund, but has given us a marketable skill as well. And our final acknowledgments bring us to the history of OFG. Jody and Leighton Smith. Mr. Smith worked for Solomon Brothers in New York for many years before retiring and moving to Florida. So once in Florida, they became great friends of UNF, and the Smiths wanted to give UNF students an experience similar to that like Mr. Smith had at Solomon Brothers. So in partnership with now Provost and then Dean Dr. Earl Trainum, the Smiths developed the concept of Osprey Financial Group. And it was really important to the Smiths that students manage real money, so they donated our $500,000 initial principal. State Farm donated $100,000, partially matched by the state of Florida, to build our trading room, and the fund launched in the fall of 2002. So our trading room is state-of-the-art. We have a Bloomberg terminal, we have flat-screen television monitors that help us stay on top of the news, we have computer workstations with dual flat-screen monitors, and in addition to Bloomberg and Black Diamond, we have access to Morningstar, Briefing.com, and Investors.com. So all these resources allow us to operate in a completely professional environment and give us a very real-world experience. I'm now going to turn it over to Eric Corrigan to talk about alumni.
Thank you, Colleen. So, as Dr. Lambda mentioned, including us, there have been 13 editions of the Osprey Financial Group comprised of over 140 students. And each year, the current OFG class picks up where the previous year's class left off. Over our investment period, we've had great opportunities with actually meeting alums that have come through the same program we have. For instance, at our very first meeting back in August, Tanya Coombs, who was in OFG in 2006-2007, came in and gave us a great demonstration on what her experience in OFG was like. She also is the representative of the client, being the UNF Investment Committee, and laid out the rules and regulations that they expect us to follow being active portfolio managers. Also, we had several other alums come in, give presentations on how to go about performing due diligence when searching for securities, and it really showed us the work that has to go into being an OFG and searching for securities. I'm now going to take you on a little tour of where our alums are today. So with 140 alums, obviously most of them here in the Southeast, Florida, Georgia, North Carolina. We also have 8 in the Midwest, 1 in Arizona, 1 in Seattle, Washington, and we currently have 15 OFGers working in New York, including 3 from last year. OFG also has some international exposure with 1 student working in Mexico, 1 in Prague, and another in Saudi Arabia. So pretty big dispersion between Saudi Arabia and Seattle, Washington. And that's something that we're really proud of as current OFG students. It's really important to us, and we're very thankful to the 10 alums that are here today, all the advice you have given us along the way, and we really appreciate all the support that you've given us throughout our process in OFG. So I would now like to hand it over to Ryan Dunn, who will discuss the OFG experience.
Thank you, Eric. OFG is designed to create a team of top students in the Coggin College and equip us with the tools of the pros. We are selected through a thorough application and interview process, then assigned roles based on our strengths. Next, we are conditioned to eat, breathe, and sleep finance with one priority, beating the bench. Analysts are responsible for keeping up with the news, screening for equities, and navigating the wealth of information available to us on the Bloomberg terminal and other resources. When you find a play that shows promise, you partner up and analyze in depth. If you like what you find, you move on to the next step, buy-side report. Buy-side reports are an analyst's opportunity to win over his or her peers. Each buy-side report paints the full picture of the play, and it concludes with our signature fear and greed section, where analysts give the full disclosure of risk and reward. When Tuesday night rolls around, our meetings are professionally organized according to the weekly agenda. Each week, our meeting starts with a state of the market report by our fund technician, followed by political, statistical, and economic updates. After the usual business, we move on to any new plays being pitched that week. The majority of our decision-making takes place during class hours. However, there's extensive communication required outside of class in order to increase the agility of our decision-making process. Our two primary methods of communicating outside of class are the UNF Blackboard site and, of course, email. By keeping a constant dialogue going between the group, we're able to make game time decisions on any of our existing positions, and we do so via an email vote. This year in OFG, we also had two firsts. Here you see our very own Chris Brady pictured participating in a meeting via a conference call from the airport in New York. Each member's input is highly valued, so even if it's coming from New York, we highly value that information, participation in our meeting. And lastly, we were paid a visit by a furry winged guest to the trading room in the form of a bat, which I was lucky enough to have turn up underneath my desk, and there you have it. So now that I've given you a taste of the OFG experience, I'm going to hand it over to my colleague Sebastian Munoz, who's going to cover our officer and analyst positions.
Thank you, Ryan. Now, every member of the group has two different roles. This is an officer position and an analyst specialty position. And they also determine how we contribute to the group and our investment strategy. So I'm going to go over every single one of us and explain to you which are the different roles for each person. Now, this is Christian O. He was our statistician officer, and he's a commodity play specialist. As a statistician, they have a very important task. They have to present a weekly update on how our holdings are performing and where we are under or overrated relative to our bench. Now, they also use the Black Diamond Reporter software to see how our allocation is shifting as we move from one play to a different play. They were also in charge of creating our virtual portfolio. This was very important and very helpful because they chose Yahoo Finance to do it. And it gave us access to see how our holdings are performing live since the market opens until the market closes. Now, as the commodity play specialist, this is actually a new position, and this was just introduced this year. And it gave us diversity and access to a huge commodity market. So the way he could do it is either purchasing ETF, depending on where he sees an investment opportunity. This could be the soy market, it could be coffee market, or even the oil market, or just by picking a company within any industry that he sees fit. One of his plays this semester was Valero Corporation, which is a fuel transportation company. Now, Christopher Brady. He is our second statistician, and he's a value plays specialist. Now, he picks plays in two different ways. Look for a value play and a deep value play company. A value play company is a company that has a very strong fundamentals, but that trades at very low multiples, given those strong fundamentals. And a deep value play is when something bad happens to the company, but doesn't really change the fundamentals of the underlying company. So for many investors, it will be a perfect time to sell the company, but he actually sees this as a perfect opportunity to buy this stock. Now, he also creates valuation models that we also learned in Dr. Nusenberg's class, and he finds the intrinsic value of the stock, and if he believes the stock is undervalued, he buys the stock and holds it until the market realizes the full potential of the company, or he simply holds it for the investment period of the OFG. Now, one of his plays was Eli Lilly, which is a pharmaceutical company. Next, we got Mohan Guy. Mohan is our European economist and our mid-cap play specialist. Like the rest of the economists, he was in charge of presenting a weekly report of major events that happen in his region, and also where he can see an investment opportunity in Europe, for example. Now, as the mid-cap play specialist, we define mid-cap companies between 5 billion and 20 billion. So he's constantly looking for semi-mature companies that could offer long-term potential. One of his plays this semester was HGWG, which is the Germany currency hedged ETF. Jimmy Deng. Jimmy is our political officer and also our government events place specialist. Now, he's like the rest of the economists, he has to present a briefing every single week of the different events going on with the politics and his thoughts on what could happen. Now, he has a very hard task because he has to go through all the media, all the different news, and pick what really is important and what really is not. Now, he then combines that with different government events. So what is a government event? It could be a war, a new legislation, or even elections, like we had in our investment horizon. Now, one of his plays was Zimmer Holdings, which is a pharmaceutical company. Eric Corrigan, like he said before, he's an alumni relationship officer and our non-governmental event play specialist. As the alumni relationship, he was in charge of creating different events to bring our alumni and our previous OFGers, and this gave us the chance to see how their paths turned out to be after they were part of this amazing experience. Now, as the non-government events play specialist, he looks at global events such as like weather events, natural disaster, a merger and acquisition, or simply a company launching a new product. And he sees which company or how the company will benefit from it, and he seeks alpha in these different areas. One of his plays was General Holdings, which is a power generation company. And he did so to take advantage of the cold winter that we experienced in a holding period. Hal Trent. Hal is an African Oceania economist, and he's an index play specialist. He uses a top-down approach to look at economic indicators and see which countries are economically strong and keep track of different indices to invest and get some alpha for the group. He could also just be looking at indices here in North America and just looking by looking at the underlying fundamentals of the company. And that's what he saw in his place. One of his plays this semester was EPHE, which is the Philippines ETF. Ryan Day. Ryan is an Asian economist and our foreign place specialist. Now, in the past years, the world has been getting smaller and smaller and smaller. And this has been possible because globalization has connected all the different countries. So this opens opportunities in places other than North America. And this gives diversification to the group, as we don't want to have all the eggs in the same basket. Now, he also uses a top-down approach, and he looks for companies based outside North America, but that trade under American exchanges. One of his plays this semester was China Biological Products, which is a biotech company based in China. Mike Sakarna. Mike is one of our students in the MBA program, and he's also the only charter market technician now. And so he is our technical officer and a technical place specialist. He was very useful for determining entry and exit strategy, and he prevented huge losses that if we didn't have him, we could have taken even larger losses than we took in some cases. Now, as the technical place specialist, he believes that buying and selling behavior determines what he sees on the charts. And it's also translated on different patterns. So he looks for bullish patterns, and he tracks of different stocks, and that's how he determines which plays he believes can get some alpha to the group. One of his plays was Ulta Salon, which is a cosmetics company. Now, Joshua Mays. He's another student in the MBA program, and he's a North American economist and a fixed income play specialist. He's a key component for the group because 50% of our benchmark equity portion is invested in North America, and 30% of the whole allocation for our benchmark is invested in fixed income. Now, the way he picks the fixed income plays is by looking at different economic indicators, such as inflation, GDP growth, jobs reports, and he also kept track of every single Fed meeting to see where the interest rates were going through our holding period, which is one of the main topics. Now, after he gets all this information, he creates a judgment, and he tries to anticipate where the yield curve is going to move and how this will affect bonds domestically and internationally. And then he purchases and gets exposure to fixed income through different ETFs. One of his plays this semester was TDF, which is the short ETF for treasuries over 20 years. Colleen Kinneman. She is our last student in the MBA program, and she's our special projects coordinator, and she's our green place specialist. Now, as the special projects coordinator, she's in charge of creating those projects that require outside-the-box thinking, like the banner that you can see right outside the room. And as a green place specialist, she believes investors and companies believe in green practices. And this has led to the creation of new opportunities and new technologies. So she tries to pursue this investment behavior and tries to get exposure in different areas. In companies that operate, for example, in alternative energy sources, like solar companies, recycling companies, or even organic food producer companies. One of her plays this semester was Whole Food Markets Inc., which is an organic food producer. Kaylee Higginbottom, she's an operations manager and photographer officer, and she's an insider play specialist. As our operations manager and photographer, she's in charge of keeping our communication running smoothly, make sure everybody's connected, and she's also in charge of capturing those great moments that we go through our experience in OFG. Now, as the insider play specialist, she believes the chief officer for the companies know information before it's even made public. And this is reflected on their buying and selling behavior of their own company stock. Now, she can do so because they are required to file their purchases and selling public. Now, she looks at this information, looks at previous purchases and selling, and tries to anticipate what is going to happen with the company. One of her plays was equity transfer, energy equity transfer, which is a natural gas company. Lastly, myself, Sebastian Munoz, I'm the Latin American economist and a small cap play specialist. When looking for a small cap company, I was looking for two different companies: small cap value companies and growth small cap companies. A small cap value company is a company with strong fundamentals and with a really solid business model, as I believe these companies will have the long-term potential to become a large cap. For instance, take for example Apple. It started as a small cap company and now is the biggest market cap company in the world. Now, a growth small company is a company that has revenue increases year over year at a rate of 20% or more. One of my plays this semester was Fleetmatics Group PLC, which is a fleet management software provider. Now I'm going to turn it to Kaylee Higginbottom, who will explain to you our benchmark composition and the rules that OFG goes by.
Thank you, Sebastian. So Osprey Financial Group is an actively managed student investment fund, and we invest on behalf of the UNF Foundation. And as Ryan was saying earlier, we prepare, all the analysts in OFG prepare buy-side reports and then present them to the class. So all presentations require thorough and professional analysis and must pass with a 2/3 majority vote to be added to the portfolio. However, the client, who's represented by Dr. Land, can veto the play at any time, and then it won't be added to the portfolio. So we had two goals this year, which were to maximize returns and beat set benchmarks. And our bench this year was a 70-30 mix of equities versus fixed income. And the equities portion was judged against the MSCI All Country World Index, which tracks most of the larger developed countries throughout the globe. And then as you can see, the United States made up roughly half of our index, or of our bench, and then the rest were scattered throughout the world. And then as you can see, we had, this is a sector breakdown, and it's pretty diversified with financials, information technology, consumer discretionary as the top 3 sectors. And then our fixed income portion of the bench was measured against the Barclays Global Aggregate Bond Index. And as you can see, they have exposure to treasury, government-related, and corporate bonds, as well as securitized debt. And in OFG, we are only able to invest through equity instruments. So our fixed income portion of the bench is invested through various fixed income ETFs. And with that, I'm going to introduce to you Mike Sicardi, who's going to be talking about our investment environment.
So there were a lot of major news headlines and market trends that were going on during active management. Big story, the S&P 500 continuing to make all-time highs during our active management. This chart here is showing October 15 through March 31, our active management period. And the key thing here is if we look back on the first day, October 15th, that was a low in the equity markets. If we were to pull this chart back a little bit to September of last year, that was when the market was at its all-time high. We then fell about 10% to the low on October 15th, and that is the day that we took over active management. The market then shot higher through November. So obviously news got out that this group is going to take over active management, and the market went high. Maybe not, but we did go through a period of 29 straight days closing above the 5-day moving average on the S&P, which has never happened before in the history. So we had to wait until December before we got any kind of a pullback to buy the dip. And from that point, we just sort of had this choppy trading range through March 31st. So we did make a new high here in February, but even to right now, we're not too far from where we were at the top of the market in November and December of last year. Another big macro theme that was going on was the strong movement in the US dollar. This graphic here is showing 9 consecutive monthly gains on the US dollar index. That has never happened before in its 40-plus year history. So when you get currency movements like that, you see big ripple effects across other markets. One of those markets being international stocks. So this is a chart of the international equity index over our active management period. If we were to pull this chart back a bit, back to last summer, June, July is when international stocks hit their high. They then fell 17% to the October 15 bottom, much as a result of a strong US dollar weighing international stocks. US dollar continued to strengthen all the way really through our investment period, but international stocks underperformed up through early January of this year. So that's when we saw an inflection on an absolute and a relative basis for international stocks compared to US stocks. International stocks then rallied sharply. In fact, year to date, international stocks are up about 8% versus the S&P 500 up about 2%. Sticking on that international theme, this graphic here shows the current yields on various 2-year government bonds. So these are mainly European economies. Here on the right, I have the United States just for perspective. So this is just showing everything in red is a negative yield, a negative interest rate on a 2-year government bond. So if you were to buy a 2-year Swiss bond right now, you would be paying nearly 80 basis points to own that. The point on this chart is simply we can get markets to be so irrational. They can do things that we just don't expect. And in this marketplace right now, I'm sure a lot of us are seeing that going on in various other markets as well. So this is just another big macro theme that our group had to deal with and form a strategy around it. And another market that was certainly impacted by a strong US dollar, crude oil. And I'm sure most folks in this room are aware of the movement in crude oil in the last year or so. So back to June of last year, crude oil hit $110 a barrel. It then fell down to $43 a barrel in January. Had a brief rally, but then made a new low just last month, about $42 a barrel. Since then, it's rallied pretty sharply now up to the mid to high 50s. It's just past the $54, $55 area, which is a pretty key technical point. So we'll see if that is indeed the bottom, but certainly a big time move in crude oil. And one of the ripple effects of that is a boon to consumer stocks. So consumer discretionary, consumer staple stocks have outperformed the overall market in the last year or so. And finally, here's a source of leadership for the stock market recently has been U.S. small caps, as measured by the Russell 2000 index here. This chart going back to January of last year, so a bit longer perspective on this chart, you can see this general consolidation, this trading range in which the Russell 2000 traded for much of 2014. And then we had this breakdown here last October. If you remember that S&P chart when we hit that low on October 15, small caps made a new low here, but this was a bullish false breakdown as we quickly rallied back above the support level, and now we've rallied to all-time highs in the Russell 2000. So the Russell is up quite a bit year to date, whereas the S&P is, more or less flat, maybe up a couple percent. So the chart on the Russell 2000 is actually looking pretty good right now. And finally, volatility, the VIX, the CBOE Volatility Index. This chart here showing our active management period. Each data point here is the high print of the day on the VIX, just for perspective. The key thing here is day one of trading, the VIX hit above 31, which was a 3-year high in volatility for the stock market. So literally within hours of us taking the reins of the portfolio, it was the most volatile day as measured by the VIX for the stock market in the last 3 years. So, what a way to get started for us. We have the highest print of the VIX in the last 3 years as we get going. Equity markets then rallied pretty well through the end of the year. We did see bump ups in volatility around dips in the market, but generally we've been holding to this sort of mid-teens range, which has been sort of the norm for the stock market here in the last few years with the bull market going on. So we had a lot of market trends and news headlines going on for us to handle and develop our fund strategies. So with that, I'll turn it over to Christopher Brady and Josh Mays, and they'll discuss our fund strategy.
Thank you, Mike. So starting off with the overall portfolio, this year the Osprey Financial Group combined 2 commonly used strategies to create a hybrid strategy for the fund. The first was a global macro strategy, which is typically used by hedge fund managers, where what they do is they'll make bets on different portions of the world, different economies, different commodities, currencies, and from there they'll find the correct financial instruments to use to take advantage of whatever that hypothesis is they've come up with. We combined that type of a strategy with a bottom-up strategy so that since we can't use varying financial instruments, what we did, we come up with hypotheses for different regions of the world, currencies, and from there we would find equities that related to those hypotheses that we come up with so we could take advantage of what it was that we found. Some examples of this are with currency hedge ETFs and getting into energy stocks when oil prices were at certain levels. In terms of our asset allocation, you can see here on the screen what our asset allocation was as of March 31st, which is our last trading day. However, this allocation properly reflects the sentiment of our group throughout the entire holding period. You can see that in comparison to the bench, which is 70% equities and 30% fixed income, we remained overweight in equities at about 75 to 77% range, and underweight on the fixed income side, and the low 20s for the majority period. The cash portion that we had remained around 5% of our portfolio for the entire time, and we allocated this to our fixed income portion. Due to our bearish sentiments on fixed income, we felt like we were going to get a higher return in cash than we would in some of the fixed income instruments that we could have invested in. The one thing that's not shown from this graph, though, is where our allocation was globally. So one thing that we made a conscious effort of this year was making sure to say, okay, so our benchmark looks like this, what do we look like? And we were overweight or underweight in specific parts of the world based on what we felt, kind of using that global macro strategy. So for the equity portion of the portfolio, we started the year off overweight in U.S. equities in comparison to international equities, which worked well as U.S. markets started to rise. As we started 2015, that shifted to where we were underweight U.S. equities and overweight internationals, which also worked out very well as the international equities gained strength in comparison to U.S. equities. In terms of our equity strategy, we combined both fundamental and technical analysis, which gave us the most thorough possible analysis we could for every equity we got into. On the fundamental side, every single position had a thorough business analysis with a management overview, an industry and peer analysis, as well as a financial analysis and evaluation. On the technical side, our technician was able to give us proper entry and exit points on every single position we got into to ensure that we had the proper risk-reward scenario on every equity. So that if there was going to be a loss, it was going to be minimized and all of our upsides could be to the highest potential possible.
The universe of investments available for OFG to invest in fall into two asset classes, either equity, as Chris went over, or fixed income. This year's version of OFG took a slightly more aggressive approach than some past OFGs have done in defining fixed income. We included both preferred equity and master limited partnerships under the heading of fixed income. This was done mainly because of the sensitivity of these investments to the interest rate environment. Throughout the management period, we actively managed risk and opportunities in order with the goal of beating the benchmark on an absolute basis and also on a risk-adjusted basis. Interest rate risk was managed through duration, where we kept a lower duration than the benchmark throughout the management period in anticipation or fear of a rising interest rate environment to come. Default and credit risk was managed by increasing our exposure to lower credit quality investment during times we foresaw tightening credit spreads. Currency and exchange rate risk became a really important one. As Mike went over, the strength of the US dollar would have, all else equal, hurt our international investments. We hedged some of those international investments, which benefited us in the end. Looking at inflation, unemployment, FOMC minutes, and press conferences, market expectations and reactions to all of those were all important and included in each report or play that was pitched on the fixed income side. Looking at inflation, not only did we look at personal consumer PCE, but also at CPI and the tip spread. It wasn't surprising that we saw an environment of declining inflation rates as oil prices declining from the summer highs fed through headline inflation, affecting core inflation somewhat to the end of 2014 into 2015. The credit spread was also very important. Throughout the majority of the investment period, we saw rising credit spreads. We were able to take some advantage of tightening credit spreads at the beginning of 2015 by gaining exposure to LQD, which is an ETF that has slightly lower credit quality than the benchmark does. Again, the dollar was very important in the strength that it had, especially during the second semester, where all fixed income investments were hedged against a rise in the dollar. So that the increase you see there in the end of March, we'll talk about that a little bit later as we get to the performance of the fixed income portion of the portfolio.
now it's time for the part that you came here for. Looking at the overall performance for the fund this year, this was a monumental year as it was the first time the fund's ever closed over $1 million. We started the year off at $961,000 and finished the year at $1,017,000. This was an OFG return of 5.77% compared to the benchmark return of 4.24%. And after fees, we had a net alpha of 111 basis points. On the equity side, we also outperformed our benchmark. As you can see, we had a 97 basis point alpha for the equity portion, with the total return for OFG of 9.1% on the equity side. These are also our top performers on the equity side. So Eli Lilly is a large cap pharmaceutical company in the United States. China Biologic is a small cap biotech company placed in the plasma industry in China. HEWG is the currency hedged MSCI Europe index, or Germany index, excuse me. FLTX is Fleetmatics Inc., which is a small cap company based in Ireland that focuses on software for the transportation and logistics industry. HEDG is the MSCI currency hedged Europe index. And Whole Foods was a consumer retail company, or consumer food retail company in the United States, focused on the green organic products.
So here we have the performance of the fixed income asset class that OFG invested in, the red line on the top, and in blue, the benchmark. The first thing that is visible, obviously, is during the first semester, we really stuck pretty close to the benchmark. The second semester is where we were able to really outperform the bench, specifically by not taking this huge dive that the benchmark took towards the end of the semester. This can be explained for two reasons. First, here we have overlaid the US dollar index. You can see the dip in the benchmark corresponds to a spike in the US dollar index. We're able to avoid this, as I mentioned earlier, by hedging all of our international investments against movement in the dollar during the second semester. Additionally, somewhere in February, the end of February, we had an all-time low in the 30-year US bond. This was quickly followed by a better than expected jobs report in March, and we had a spike in the 10-year rate up to about 2.25, I believe. Again, we were able to avoid the dip that was caused by this increase in yields by increasing our exposure to cash and by directly investing in TBF or inverse shorting the treasuries during this time. Getting into some specifics of the statistics of the portfolio, on an absolute basis, the fixed income class of the portfolio lost value over the investment term. However, we lost less than the bench did. So we were able to outperform the bench not only on a relative basis, but also on a risk-adjusted basis. The mean daily return of our investments was about -3 basis points. The benchmark lost about 5 basis points as a mean per day. Taking this along with standard deviation and assuming a 0% risk-free rate, we can get a standard deviation of our investments of about -1 versus the benchmark of about -1.5. We outperformed the benchmark on a risk-adjusted basis. Also looking at kind of a value at risk percentage here, we could be 95% confident, assuming a normal distribution of returns, that we would not lose more than 48 basis points on a daily basis. For the bench, we could be 95% confident we'll not lose more than 59 basis points. Looking at a histogram of both of these daily distributions, on the left we have our performance, on the right the benchmark. It's clear that there's some negative skewness to our returns on a daily basis. We also had excess negative kurtosis versus a normal distribution. Assuming this, and forgive my pronunciation, but using Chavez inequality, we can be confident of the same percentage losses on a daily basis, but at a 40% level of confidence versus a 95% level of confidence. Now I'm going to pass it on to Christian Oedner, who will go over some statistics for the portfolio as a whole.
Thank you, Josh. Chris? Regarding portfolio statistics, the equity portion of our portfolio had a beta of 1.08 and an R-squared of 0.89. As expected, the fixed income portion had a lower beta of 0.45, although the R-squared of 0.29 indicates a low statistical relationship between the two. The equity portion of our portfolio had a daily standard deviation of 86 basis points and an annualized standard deviation of 13.71%, whereas the fixed income portion of our portfolio had a daily standard deviation of 27 basis points and an annualized standard deviation of 4.36%. Overall, the whole portfolio had a daily standard deviation of 65 basis points and an annualized standard deviation of 10.3%. The next charts talk about, they take a look at all of our equities in closer detail. The orange lines indicate the absolute performance for each of our equities, and the blue lines represent the individual alpha for that stock after the equity's performance during the same period is backed out. For instance, Fleetmatics had an absolute return of 15.46%. During the same period, the equity returned 1.52%, giving it an alpha of 13.94%. It's important to look at the individual overperformance or underperformance because absolute returns can be misleading. If you look at Citi, it had an absolute return of negative 6.54%. During that same period, however, the equity returned negative 5.63%. Based on absolute returns, Citi would be ranked 7th from the bottom of all of our equities, after taking into consideration the fact that it only underperformed the equity by 91 basis points. It moved up 14 places in the rankings. The flip side of that are equities that look just as bad upon closer inspection. Sasol, a play for which I was partially responsible as a commodities analyst, provided an absolute return of negative 12.66%. However, during that period, the equity was largely flat, returning just negative 2 basis points, meaning that that individual stock had an alpha of negative 12.64%. I'm now going to hand it off to Kyle Trenner, who's going to go over historical returns.
Thank you, Chris. All right, thank you, Christian. As Chris mentioned earlier, this is the very first edition of the Osprey Financial Group to close active management at over $1 million. This historic moment is the product of 13 editions, as the previous 12 editions contributed over 92% of the growth to the $1 million mark. So let's take a look at their performance as well as ours. The calendar year for the Osprey Financial Group consists of active as well as passive management periods. Active management begins in the fall and ends in the spring. It's a time of intense research, weekly meetings, presentations, and the ability for the fund to be allocated according to current market conditions. The passive management period, on the other hand, begins in spring and goes through the summer. It's the final task for an OFG member to help position the fund for the summer months when nobody will be here to actively manage it. So when we see calendar year data, we're actually seeing both active and passive management information. And then I'll go by active and passive. So since the fund was created in 2002, Osprey Financial Group members have collectively contributed over $517,000 of growth to the fund. The fund has also outperformed the underlying benchmark by a cumulative alpha of 9.97%. The largest growth occurred in 2003, and the largest loss occurred in 2008. So taking a look at just the active management portion, it has succeeded relatively well. In fact, $493,000 of the $517,000 of growth has come from the active management period, which is when we are actively choosing stocks. 7 out of 13 editions have outperformed their benchmark during their period, and the average return has been 4.77% per active management period. Passive management, on the other hand, hasn't been as successful. Cumulatively, passive management has returned $24,000 of the $517,000 of growth, and only 4 of 12 passive management editions have outperformed their index. However, we believe this is an opportunity for growth, for improvement going forward, and it also highlights the relative strength of the active management period. So, sustained cumulative alpha is the goal of this type of asset management. We want to beat our bench consecutively. And this has been achieved by OFG for 10 of the past 14 calendar year data points. The spike you see in 2008 is attributable to that addition cautiously deciding to allocate a large portion of their cash to their portfolio. And as the markets depreciated around them, that cash became a valuable alpha-generating asset. However, as they approached their spring passive management period, they had to make a decision. Were they going to keep it in cash or go into equities in that uncertain environment? And they decided to go with the risk management approach and hold a lot of that cash. However, the markets rallied during these summer months. So that's where a lot of the alpha was lost from. However, this edition of OFG is proud to have contributed to the now second highest level of alpha since that 2008 period, measured by calendar years. And we're looking forward to positioning the fund well for our summer passive management period. So now I'm going to hand it off to Jimmy, who's going to take us through the budget and expenses.
Thank you. So the UNF Foundation allows us to operate with a discretionary budget totaling or equaling 75 basis points of assets under management as of July 31st, 2014, which for us was a little over $7,000. And this money was put in place and used to enhance each member's experience during our tenure. Here's a list of the expenses that we incurred. Spend them on investing resources, just at Morningstar.com, investors.com, briefing.com. We also use it to finance events such as this lunch and the CFA lunches and dinners. We also purchase promotional items such as the sign you saw up front and our shirts, which can be seen in our headshots in the annual report. Here's a picture of the 8 members that we were able to send to the CFA Forecast Center at Jacksonville Golf and Country Club. And with this budget, we were able to purchase a table and mingle and network and get to know what the pros actually go through, and a lot of the problems are the same as ours. And this is Joshua Mays at a CFA lunch featuring Chris Vincent, and he was putting on a presentation called Everything You Wanted to Know About Fixed Income But We're Afraid to Ask. So it was very helpful to be able to send our fixed income analysts to this luncheon. We were also able to have an alumni social at Frigo Tuscan Grill. With this budget, we were able to provide food and create a happy hour setting. We also had a special guest, Rob Urban, who was in town from, at the time, New York, now in town from North Carolina. He was an OFG alumni, class 2007, 2008, and he was here to serve as the UNF Professor of the Day, and just so happened we had this event the same night. And here's a list of the resources that we used besides Bloomberg, and I can't really speak to each specific one because every analyst had a different combination, or once you get in your groove, you want to do the same thing, and everyone had a different routine. So that's how we use those. And then the results, we had a realized management fee of 41 basis points, or $4,033.11, with a surplus of a little over $3,000. And on behalf of the group, I'd like to thank the foundation for allowing us to have this budget, as we believe, again, it has enhanced our experience. I'm now going to turn it over to Mel Ghanem, who's going to cover all the events of the year.
Thank you, Jimmy. During the 2014 and 2015 edition of the Osprey Financial Group, we had a lot of commitments and events in our agendas. Now, all of these commitments and events were not only based on the development of the fund, but also the development of our professional persona and giving back to the community. These are the following events we had during 2014 and 2015 edition of OFG. In our very first meeting, we met with Tanya Kunz, which she represents a client, and she's also an alum of Osprey Financial Group. She introduced us to her experiences at her edition of OFG, and also gave us the goals the UNF Endowment wanted us to meet, being the benchmark and promote this exceptional program. After that, we met with George Prados at Morgan Stanley. He gave us a really detailed presentation about asset allocation, a very important fact in portfolio management. So after this 3.5-hour meeting, he rewarded us with a delicious pizza. Next, we met with Darren Myers with Perella Weinberg. He's our counterpart in managing the rest of the fund. He gave us a detailed presentation on how diversification of the fund helps us meet a long-term goal. Now, this is one of the most outstanding events during our 2014 and 2015 edition of Osprey Financial Group, where we met Melissa Daniels, Jimmy Daniels' sister. She introduced us to Junior Achievement of North Florida. Their mission is to empower the community to own their financial success. So we went to the Southside States Elementary School, and a few of our members taught students about how important is financial knowledge in their lives. So here we can see Jimmy and Christian. also Kyle and Chris teaching some young students. Now, Eric Corrigan, our alumni director, organized this social at Rio Tuscan Grill, where we got to meet all the alumni. We got to hear about their experience, their knowledge, and their advice to follow our dreams. Next, we met with Sean Warrington with DuPont Trust. It is always important to know what their peers are doing in the industry. He explained us what the DuPont Trust is and how their top-down strategy helps us develop their funds. Now, we met with Thomas Kearney at Early Alpha. This is one of the most interesting persons I met. He graduated high school, and as soon as he turned 18, he went to work in Chicago for a private financial firm. Now he's working with Early Alpha, a project of his own, where he's going to put research like ours out in the market, so to help companies and to help us get outside in the market. Now, we also want to thank the CFA Society here in Jacksonville for letting us be part of their meetings and getting to know them. So with that, I conclude the 2014-2015 edition of the Osprey Financial Group, and I believe I speak on behalf of everyone in the group when I say thank you. Thank you, Dr. Lam, for leading us, and thank you, everyone, for letting us be part of this journey and represent the very best of the best at the College of Business. So, any questions you have, we'll be glad to answer them.
So, did Dr. Lamb overrule you on any of your recommendations this year, and if so, which one?
I believe he did in one of the plays.
Yeah, he actually, over spring break, we had an implied hold on one of our companies, and Dr. Lamb thought it was pretty volatile and it was moving too much, so he vetoed our implied hold and we sold it this year.
And that one was more of a window dressing play. We have a constraint of time with the fund, and we close out the active management period at the end of March. And the play that she's talking about is CTCM, which was an incredibly volatile stock, and it was just plunging. And in the long run, it would be a great play. In fact, it has recovered all of what it lost over spring break and has gone positive. So that one, though, was, given our time frame, end of March, we just can't sit on this thing and let it leave. We need to get out of that, and maybe if we had a longer term perspective, it would certainly be part of the portfolio, but we're more October to April, and so we can do that. And I can't veto anything because I think it would be a boneheaded move to move into this stuff, because I don't like that goes beyond the scope of what the Smiths envisioned. I can't veto anything because I don't think it would be a good play. I can only veto if it violates a rule, or if it, for instance, if we have a rule about how much small cap we can have in the portfolio, and taking this small cap position would take us over that, and they vote to buy it without selling something else, I would veto that, and then they have to sell something small to come into that range. So it's really a technicality veto that I have. Otherwise, it would become my de facto land manage. That was the only.
To give some perspective on that one too, it was a small cap Russian-based media company. So to give you an idea of how volatile that was.
Any thoughts of adding alternative investments to the portfolio?
I think that would be a question
What
for
do you mean by
foundation.
alternative?
Hedge funds, private equity managers on the more passive side, because in part for
Some of it would come down to what we were able to get into because of what was available on the bond side, for example. A lot of our investments had to be in exchange traded funds because we didn't have capital to really get into a direct bond investment. So that would fall in there a little bit, I think.
during the presentation, something was mentioned about passive management being opportunity of growth. What exactly do you mean? And within the purview of the foundation's boundaries, what can you do? I mean, does it any different than what other people have done before? I'm just interested what your interpretation is.
I misspoke. I said opportunity for growth, but then I meant improvement. Maybe just something. Maybe we will be able to learn from what they've done and try to improve upon the performance.
What have they done in the past, really? What is the passive management?
Well, in the past, I believe they have put all the money towards the bench. So if the bench goes up, goes down, it wouldn't mean anything to us because we're not going to create any alpha. So what the previous edition of OFG made was to allocate the assets in different ETFs or different plays that will give us a better performance.
But are you, by definition, are you responsible for the passive management period of time, or how does it work? Because by the time you're done with it, you should be done. So how...
We're responsible for allocating it according to our views going into the summer. So we, typically, we're gonna kind of move towards the bench, but take little pockets of diversification, like small cap strength. We might say we'll be overweight small caps. You know, we might pick a trend on the US dollar and say, here we could benefit from this, but it's going to be slight diversification away from the bench, not like full-blown, just, you know, put money everywhere.
Let me jump in here too and add one component to it. If the students you're looking at, they're all graduating. So there isn't anybody there to manage the fund before the active period stops, because they are the active period. We're in the process right now of forming the new class. And during the summer, those students get up to speed in getting certified in Bloomberg, in learning their officer and specialist roles. And then in the fall, we jump in and take the active part on right away. So the passive part is not something like what you professionals manage, because you're looking at it all the time. Our active managers are going to be gone. So what they do as they exit is use a lot of risk management, a lot of stocks, ETFs, safe ETFs, large caps, you know, those kinds of things to preserve capital. But should those instruments stop out because the market is drifting lower and lower and lower,